I'm here today with Alex Bernal. We met last year at John's workshop in Cambria. I think he had as excellent of a time as I did, and he wanted to talk a little bit about his experience with cycles and his experience with the Mesa techniques and just some of his trading experiences in general. Here's our standard NFA disclaimer. Risk of trading commodities or futures can be substantial. Potential risks, in addition to potential rewards, certainly has to be kept in mind, making sure that any investing or trading that you do is within your means. So Alex, welcome.
Yeah, thanks for having me. I thought this would be an interesting kind of thing to do because sometimes people look at John's material and it's very technical. I just kind of wanted to give a different view about just some of my opinions and my experience with some of this and how it kind of pertains to the subject of cycles and then John's workshop if people are interested. A little background about myself is I'm a technician, a CMT holder, and a CFTE holder.
Can you explain a little what those are? I was going to ask you about the
people are more familiar with the Chartered Financial Analyst Program, CFA, and so that's for the fundamental side, sort of an accredited certification from a regulating body. And there's another one of those called the Market Technicians Association that's for technical analysis based in New York. Their designation is the CMT. So there's a series of tests you have to take, and you have to have industry experience and whatnot to have these. Through my career as a trader and as an analyst, I was always interested in cycles as a subject because it's something that's a little bit ephemeral to most people. It's not necessarily something that can be defined in any one single way. And I've always sort of been drawn to particular techniques and pieces of trading science that are considered somewhat predictive. So they're forward-looking rather than descriptive or reactive. So that's kind of what drew me to this. You know, the math for some people seems a little daunting. And, I actually read a lot of John's books before I actually met John and attended the workshop. And I could tell you it's a little bit easier than you'd think. If you're not so strong with coding yet, I'll tell you it just takes a little bit of effort. And I think that portion of how to understand this technology can be easily attained. The last thing I wanted to stress is this topic of predictive versus descriptive. And this is something that, I learned for working for a few different companies, but most technical analysis, as you probably can realize, is just descriptive, meaning it using math or functions to tell you what price is doing right now. In a lot of instances, it's even worse than that, where it tells you what price has done in the past because it has lag inside of the calculation. And so what I'm going to try to point out as something as we go through this is why having predictive or low lag indicators, why is it so important?
You mentioned DSP, digital signal processing.
Right.
Can you just give us a brief idea for those who may not know specifically what that is, how it relates to trading and why it may be useful for someone to at least have an understanding, if not a deep knowledge of it?
Essentially, DSP, if you think about it in the most simplest sense, when you sit in a car, and they don't really have these nowadays, but maybe 10 years ago, and you turn the dial to your FM radio, what you're actually doing is you're just changing the frequency that your radio is allowing you to hear. That's essentially one form of a very simplistic example of digital signal processing, where it's processing a signal frequency that's, whatever your favorite channel is, here in California it's 92.9 or in LA it's K-Rock. The difference between those two channels is a digital signal process. And so I'll actually dive into that a little bit deeper in a few slides. One of the things that really drew me to digital signal processing was it seemed like there wasn't too much material out there, maybe 10, 15 years ago on this particular subject, because it was more focused from a engineering perspective, like electrical engineering or even different types of radio engineering, visual spectrum engineering, so like processing light or laser beams or whatnot. So it didn't seem to me off the first pass that I had to try to investigate this, that there really was anything tangible for me to translate over into trading. Until a few years ago, I noticed when I was reading about the history of the publicly successful hedge funds in the world, Renaissance Capital, and there was a little passage that really caught my eye, and it was about this guy, Mukund, I don't really know how to pronounce his last name, Padman, PhD, and he was a DSP expert, PhD. And I thought that was quite interesting that the head or one of the head people in their research department was a digital signal processing PhD. So that's what really caught my eye. And then I've started to capture other little tidbits that I found here and there. For example, Tower Research Capital, which is I think billions of dollars in New York. Their founder and managing director, Mark Gordon, has a master's degree in electrical engineering, and he previously worked for Lockheed, and he specialized, and this is on his webpage, in digital signal processing and speech recognition. And then they boast on their website that they employ over 70 DSP engineers. So I thought that was also interesting, that they were so public about this. There's got to be something here if these really successful hedge funds have this type of scientists on staff. The last thing I noticed was actually a few years ago, the London Financial Signal Processing Laboratory, which I was unaware of until I read the article. Their whole manifesto is they focus on financial signal processing as part of electrical and electronic engineering department. I think they're more talking to how they have some type of program for HFT, but it's basically in the same scientific discipline.
Right. So this DSP seems like it's something that a lot of the institutional types of traders and funds and such are aware of and are actively using. But what John's trying to do is bring that to the kind of retail guy.
Right,
so
exactly.
To take advantage of some of the same ideas and techniques that these hedge funds are using. And what you're saying is that it's not necessarily rocket science, that with a little bit of understanding can incorporate this into your trading plan.
Absolutely. I think, for me, it took a little bit of really thinking about what I was trying to apply, but one of the things that I told John after last year's workshop is there's certain parts of it that are somewhat opaque or somewhat abstract. And unless you're really a trained electrical engineer, those things are hard to grasp at the first pass. And then once you get a little bit deeper and maybe learn a different aspect of how to understand the specific parts of DSP, then it actually starts to click. So that was actually something I really wanted to share with people that are considering going to the workshop is, I consider myself pretty savvy with understanding particular quantitative methods, but there were certain things I did get stuck on in the beginning of learning this material. This is something that I knew before I attended the workshop and I started working with John, but it didn't really clarify as such until after. And it's this concept of descriptive versus predictive. And a really smart person that was sort of a mentor to me when I first began trading explained technical analysis to me. He sort of poo-pooed it a little bit. He said, using technical analysis is like trying to drive down the highway, but only using your rearview mirror. And I thought that was always an interesting thing to say because in a lot of respects it's kind of true, but it's not in every single instance. For some people that are interested in going to the workshop, there's a big component with trading systems, how to apply this within automated algorithms. And so I was just going to touch on that in a few different slides. And one of the key concepts that I knew before I got into DSP is in order to have high expectancy, which is key for algorithms, and I'll explain why, you have to have the least amount of lag inside the system. And the reason that is you have to be able to get a signal that's whatever you're trying to do, the function to buy or sell, you need to get that in the most timely fashion so that you can buy or sell at the moment that you need to do that. If you have to wait because of the indicator you're using or the function you're using, you're basically giving the market, more time to allow you to have more slippage or whatnot.
Right. So what you're saying is that a lot of the frustration that some of the traders may be having with the indicators and the strategies that they're using now is due to this lag component.
Yeah, and I'll be frank, a lot of these indicators that are off the shelf that people use have been around for 50 years, before there was computers. There are things that they should be understood, but we're in the age that there's much more processing power and there's just much more information out there. Most of the things that you have basically default installed on your machine have already been improved and can be improved further. Before we dive into kind of the lag factor a bit more, I wanted to kind of share this one thing that really caught me at the workshop. As I was talking to John from time to time, he kept saying this thing, frequency domain, and he would say things like the frequency of the system. And I didn't really understand what that means. It was really abstract to me, and I knew it was a big part of what was going on. And then I saw this image, and it really clicked with me of what he was talking about, where if you think about any trader that's looking at a computer screen, every single one of us is looking at it in terms of the time domain, meaning from left to right, every bar that prints is a new unit of time. As we go from the beginning of the day to the end of the day, we're moving to the right across the time domain. And one of the really unique things that is going on inside of digital signal processing, most of John's work, is this concept of the frequency domain. And you can see here in this image, he's analyzing how this functions operate on a totally different axis. And this is really what kind of made me think, wow, there's something here that not a lot of people realize, because there's this whole nother plane that is being ignored by the majority of traders. And so I'll show you a couple different instances in why this has improved some of the things I've been working on.
So while everybody is looking at the information from one angle, what John can do is provide a different perspective,
right,
and maybe generate some insight or what the market may do from that different perspective.
Right. You got to remember that now in the days of big data and, massive computational power, not far-fetched to think that a lot of what is possible in terms of trading systems has already been data mined. There's only so many different combinations of high, low, close, and, different clusters of bars that can be tested. If you really think about it, there's really not that much financial data. I mean, the S&P only goes back, 100-something years. In terms of big data, that's not a lot of samples. So I always was attracted to this because this is a completely different angle. This might be someplace that is being ignored by the rest of the industry. I wanted to show this because this is something I deal with a lot in my day-to-day. I work for a company now called Parallax Financial Research, and we're a little boutique company, but a huge facet of what we do for our clients is we operate in the sense of what is our edge. And what is an edge? An edge is, if you guys have read Edward Thorp's book or any gambling tutorials, an edge is basically a better than 50-50 probability. In trading, it's so important for successful trading systems and even manually used discretionary indicators. It's so important, in my view, to understand what your edge is, because if the indicator you're using is not better than 50-50 in what it's telling you, how can it really be beneficial over thousands of trades? This is something we test a lot. What this graph basically signals is how we basically measure what a signal is in terms of edge. And then an edge doesn't necessarily exist in one piece of time. An edge can last, many, many minutes or bars or whatever you want to call it. A good example is like, imagine you're in Vegas and late at night the pit boss just gets sleepy and he forgets to make all the blackjack dealers, reshuffle their shoes, and they get down to the last 20 cards and he forgets to tell them to reshuffle. That there's a period of time that you're going to have a very high edge.
And that's just a function of math.
Right, it's just a function of math. It's a function of, I know there's few amount of cards left, so I can calculate what my edge is, and I know up until the time he reshuffles the shoe, my edge should last, however many minutes. So that's something that is really important in not only indicators, but also trading systems. And the reason it's important is if you look at any type of signal over thousands and thousands of samples, if you don't have positive expectancy, meaning if you don't have something that produces a gain, a profit, more than it produces a loss, there's just no mathematical way that you're, one, going to beat your commission costs, but two, going to be successful in the long run.
And that was it. I was having a discussion with a very prominent trader that's a discretionary trader. And my question was, if you can't test your strategy, or you're flying by the seat of your pants, so to speak, and relying on your
gut,
right, and your experience to make trades, well, how do you know what to expect, and how do you know when your system is working and when it isn't? And that's what I find so beneficial in some of the programs that John writes and others, is that you do have this expectancy, and you have a way to determine whether or not you should continue down that path, or if something is actually broken and you need to look elsewhere. And I think that's very important. And I think a lot of people that are trading don't have any idea of, number one, like you said, whether their system has a probability, an expectation of profit, and what that might be.
Right. It's so important to know what your edge is. It really is. I mean, it can make or break your trading career. Stealing something from what John told me the other day is DSP allows you to apply scientific technical analysis. And that's really where it's going. Like, if you think about what the industry is today, and with all the really smart people and powerful computers, it's all science now. It's all trying to data mine for positive expectancy, across every single market.
Right. I think we should maybe interject here that this is all, no matter how much analysis you can do, it's based on probability. There's no guarantee that over a particular time frame that any strategy is going to be profitable. What you're doing is trying to figure out, well, are the odds on my side, or the edge as you call it? And if it is, that's something that I want to go with, but understanding that the market can do things that the system didn't take into consideration.
Absolutely. I mean, the only guarantee I know of is there's no holy grail, and every single system has losing trades. It's just impossible really to have 100% wins. Algorithm design, it's all about just winning more times than you lose. That's the bottom line. This is an interesting graph that I want to just throw in here that has to do with how I've personally been able to increase my expectancy on some of the systems I've been working on. And this is just one little function that gets covered in the workshop, and John's actually published in a few different magazines. And really what this just shows is the response, or the behavior of different moving averages. All it's measuring is simulating if price moved from 100 to 105 overnight, gapped up. What would the actual moving averages or filters look like from one day to the next? And you can see here, if you kind of just digest this a bit, this is compared to the EMA, which is that black one. You can see it's really slow, and it takes a longer period of time to get up to the new price. Some of the other ones people are familiar with, the Hull moving average and the SFF, I don't know what that one is, like a 4-year transform. You can see they overshoot. So that's important to understand. And if you're using moving averages or filters, is some of these other ones, they have the capability to giving you counter information, or they go too far, and that can be a disadvantage. And I just mentioned this one really piece of amazing filter that John showed me and we covered in the workshop. It's just a decycler. The way he's calculated how this filter works is it's much smoother, and it basically allows you to get the appropriate amount of response time between two separate points. This is just one example from my own experience on how I've been able to improve my own trading. I just wanted to show this is one of the things that we cover in the workshop. This is from my personal portfolio. I wanted, before I mention any improvements, I wanted to show, why does lag matter so much? Why does that last slide matter to me? Well, if you take this system that you developed, this is one I did in TradeStation a little while ago. On the left is I'm not including any commissions. And that's always a big pitfall for people starting off in trading, is they ignore the fact that they're going to have to pay at least $4 round trip. So you can see here, all I did in this comparison is I took a system that had no slippage, just put what I was actually going to pay. And you can see that the profitability flatlines in a lot of cases, and it just really doesn't, it's basically half as profitable. So a lot of people aren't aware of this, and one of the things I've been trying to implement in my strategy design is how to combat this. And one way is to get into your trade earlier, maybe 1 bar earlier, or 1 tick earlier, or 10 ticks earlier. One way to do that is to remove any lag in your system.
Right, and for many people, this is a sobering picture, because a lot of people aren't as familiar with proper testing procedures as maybe they
Right.
should be, and don't include these two factors, slippage and cost to trade, commissions, or they undervaluate those, can mean the difference between making money and losing money. And again, that's the important of having a realistic expectation, is you have to know what that average profit per trade is, and if it's not enough to cover those two variables, then the system's not going to make money.
Exactly. That's sort of the bottom line. Knowing that, I just wanted to show this is something that I developed after the workshop last year. I have a lot of systems that I designed, and this was one that so simple, I didn't really think it could be improved in any way. And then, after the workshop, I realized there was instances inside this where I was using some EMA, some exponential moving average calculations to smooth some things. And knowing that I can get a better response with less lag using a decycler, I just decided to swap that out. And you can see the performance drastically changed, essentially the drawdowns and whatnot, but it kind of improved it compared to the other one where I had bigger drawdowns and just periods where it kind of flattened out. This is sort of a breakout system. It holds like a couple days, and it's like 15-minute bars. So this is something that I took away from last year. Jerry, I was kind of sitting there in the room, and I was like, wow, this is one of those things I can change immediately and see if it helps.
So even if you don't take away a specific strategy as a whole, a lot of John's indicators can be incorporated into what you're already doing and could increase the return.
Yeah, increase the return or just improve what you're trying to do. I'm always a proponent of understanding what's going on in your system, and not really saying anything off the shelf should work. I mean, you should try to understand what's going on, because if you don't get pieces that are moving in your system, one, you're not going to have confidence that's going to work going forward, and two, you're not going to know how to basically build on top of that. It's really what my goal is, to gain enough experience and information on the subject of DSP that I can take a new situation that I'm looking at and know how to put some solution there. So I'll show another one just briefly. This was a scalping strategy that I had. One of the things that we look at in the workshop is this intraday model that John devised. And all of this is based around cycles, measuring the cycles within the data itself. And all I did with the current strategy that I had is I just said, don't trade. So I turned it off when we were in a down cycle. That's literally all I did. You can see that was one thing that just really improved this in a meaningful way, in my view, because it actually takes less trades and it makes essentially almost the same money, basically the same. It can be used in a few different ways. John has a lot of things that he gives out in the workshop with strategies and indicators. Really, I think where people will get the most out of it is understanding how to apply it. Yeah, I mean, one of the things that I do just sort of as an acid test is we do what's called description, full diagnostic of a system. So we just take the system in its form and we'll look at, what day of the week does it perform well? What hour of the day has the biggest winning trades? What time of the year has it the best win rate? Things like that you might not necessarily incorporate directly in the strategy. But say if you knew that this thing, had an 80% win rate in the fall and it chopped itself to death in the summertime, you don't have to turn it completely off, but you can, vary the position size period of time where you see that it does better. So that's sort of what I did here is I just took something I knew, I understood, and I was already trading, and then I just said, okay, test this kind of filter. And that way I can decide to either just double my position size in one case or not even trade. So this is the last slide. I just wanted to give some, more opinions and what I think is the value of attending this year. If you guys are interested, the strategies that John gives out alone, I think, are worth the price of the workshop. I mean, they're basically plug and play. He tells me is the best of his research to this day. I will stress, for me, it was the value of understanding and getting to talk with somebody who was applying this to trading. Because if you really look at all the resources DSP has, it's all based on electrical engineering, and it's not really directly applicable to trading. So this was a way to kind of go and hang out with John and really talk about some of the things that I was struggling with.
One of the things that I took away from it, and I wanted to ask you specifically about this, is the other attendees. My impression was that every single one of these guys had an understanding of this material and had something to contribute. Even though John is the one that is standing up in front of the room with the whiteboard, everybody in there probably has something to contribute. Probably talked to him more than I did, but folks in there were interested in collaborating to some degree.
Yeah, absolutely. We've kept a Google group afterwards that updates every now and then, but it's definitely something you have to sort of tackle as a community because there's certain things that are somewhat complex. That was actually a great thing. And what I always tell people is there's so many tools now that allow you to just optimize or brute force search into oblivion, with genetic algorithms and whatnot. And that's really the wrong approach. In all of algorithm design, it's a really garbage in, garbage out type of situation where if you don't know what you're putting into the machine you're using to build a strategy, you probably don't know what's going to come out of it. A lot of these concepts mathematically have helped me sort of filter down just a few things, that I'm using in my design nowadays. I rarely ever use simple moving averages or exponential moving averages, if at all, because I just understand the math now on how they're just disadvantaged. So that's just one good example. And in my view, this is an ungrazed pasture for edges. You see so many hedge funds and CTAs shutting down in the last year at least because, one, the market's not as volatile, but some of these edges that might have been built, in the 90s or whenever, they're just not there anymore. An example is, have you ever heard of Toby Crable's opening range breakout? Have you ever heard of this strategy?
Oh, absolutely.
Oh, yeah. So, in theory, in all the books you've ever read, it's just an amazing system. And, Larry Williams used it to make $7 million or whatever. But if you try to do that nowadays, this is a way to kind of tackle different edge people might not be focusing on.
One of the things is I'm talking to people interested in coming to this presentation. You mentioned this, you touched on it right in the beginning, is the fear of the math. And you and I had kind of talked a little bit about offering a couple of workshops prior to the meeting out in Cambria where you would go over some of the basics so they can kind of hit the ground running, so to speak, when John starts into some of these concepts. And is that something that you're still considering?
Yeah, I think great idea. This one of the things I put here in the last portion of this slide is sometimes looking at DSP in a different lens can be very beneficial. And one of the things I found, I think, after the workshop last year was this guy, Alan Downey, published a book on Amazon that's called Think DSP. And for most people, I'm a self-taught programmer, I first learned with Python. This was the easy way for me to get some of the abstract things shown to me in a way that were digestible. Now, most of the workshops in the Easy Language Trade Station, which is in certain ways very similar to Python script language. If you are considering coming to the workshop, I think we should definitely do kind of a crash course for some of this stuff.
Yeah, I think that would be a great idea, and we'll make that information available to anyone who's interested. It'll be probably either via webinar or via recording such as this, but we'd like to introduce some feedback during the session. So we'll work on that, but just to let you know that there will be some additional educational webinars coming down the road in anticipation of John's workshop, and that might, after those are done, give you a better idea of if maybe something that you're interested or maybe it might not at this particular time.
Great. Well, it was great talking to you, Jerry. And if you have anybody have any questions about attending, always available.
Appreciate that. And I have taken advantage of that with some of my clients who are interested in talking to somebody that's actually using this trenches, so to speak. Alex, I want to thank you for taking this time to spend with us this afternoon. Very informative, and I think come from an important perspective. I will put everybody's contact information, and you can give us a call or send an email if you need to.